In the last hour, Treasuries are on the move again, pushing the 10-year yield to the lowest level of the year. Joining us now, John Brady, to talk about bonds and the credit markets, because this debt deal is obviously having an impact on trade as the weak economic data this morning. John is a senior vice president at MF Global. John, how credible is the deal as you see it?
Well, I think it's pretty much at least 90% done, Margaret. And here's sort of the thinking, is that at this stage of the process, the legislative process, the results have become rather binary. And that means that if you're voting against the deal, you're actually voting for default, which is a tough proposition to take back to the voters in a short 14 months. So we think there'll be some hemming and hawing. There'll probably be a little bit of headline risk over the next 24 to 48 hours. But at the end of the day, we think Boehner will be able to cobble together 218 votes to get it through the House.
You're still confident in passage. My colleague Al Hunt is sitting here with me. You're not as confident that this is going to get through the House and the Senate.
Well, I think John's right. Ultimately, it will pass. I'm not quite sure how we'll get there. And what I really suggested was, Margaret, it may fail before it passes. It's a very tough slog. I think John's absolutely right about the default. That's a tough thing.
Right.
But also, I thought the bond markets and other places were looking for long-term structural changes, and this package does not appear to do that. I'm asking John.
Yeah, John, if it fails before it passes, I mean, what's the knee-jerk reaction?
Well, if it fails before it passes, it could be a replay of the TARP vote we saw in 2008, in which case you'd probably see a sharp drop in equities and a large rise in bond prices or drop in bond yields. But, Al, I will take a small issue with you, issue with you in the fact that I think that this agreement has some teeth when it comes later on this year, specifically around Thanksgiving and Christmas time, with this bicameral committee that's been set up and run by both parties. So if Washington gets stuck in its ways again and sort of making that sausage, I think there are going to be some triggers that kick in here, which will lend itself to perhaps further sort of physical contraction within the economy and perhaps lower bond yields over the next year or so.
John, I just would ask you, why is there reason to think that a committee will work when it hasn't worked in any, throughout this whole process? House Republicans aren't going to accept taxes. Liberal Democrats won't accept entitlements. And why do we think triggers will work now when they have never worked in the past?
Well, the triggers will be voted on over the next day or two, and those will be part of the bill. So the sense is that you're right. If there is sort of headwinds in Washington and the commission cannot put together some type of $1.2, maybe $1.3 trillion in additional savings, that budget cuts, defense cuts, healthcare cuts will automatically go into place. So that all acts as an incentive for the commission to get something done. If not, something already is done. I think the big question, Al, specifically in light of some of the weaker economic data we've seen recently, is specifically tax code reform. Will they close some of these tax loopholes? What will happen to the mortgage interest deduction? And what will that mean for the domestic economy in an important election year?
John, those at State Street are looking at August 15th as still a hard deadline in terms of a date that we could see a credit downgrade of this country, regardless of whether a deal passes today, tomorrow, or next week. How do you prepare for that?
Well, Margaret, I think we want to be careful, right? Because August 15th would be a default date. U.S. debt could still get downgraded here. Even if this deal gets voted on in the commission and Thanksgiving and Christmas, if things are triggered, the debt of the United States government could still get degraded from AAA to AA, for example, with an S&P world. So the market's reaction there would probably be negative at the very immediate short term. Probably see stocks sell off.
Of course.
Probably see bonds sell off. But remember the Japanese experience of the late 90s. Remember the Canadian experience earlier this decade, where their sovereign debt was downgraded, only to see those yields eventually head lower and see bond prices head higher.
Yeah, it's a whole different ball game when you talk about the U.S., John. It's going to be fascinating to watch. Thank you very much for giving us your quick insight.